Jupiter Wagons stock has been building up some amount of momentum over the last 2 to 3 days, and the company plans to foray into the commercial EV segment. Will Jupiter Wagons face a bumpy road ahead, or is it going to be a smooth ride? Let's bring in Anushi with the bull versus bear on Jupiter Wagons.
Right, Harsh. So what we are seeing today is that a couple of railway stocks have been in focus, and this is after the kind of market recovery that we are seeing in the couple of last few sessions itself. So Jupiter Wagons seeing strong gains today. So let's point out what are the bull case and the bear case scenarios here. Firstly, if you look, they have hiked their stake in its arm, that's Jupiter Electric Mobility. Just a few days ago, a while back, the company had announced that it has launched its first commercial EV, that which is TACE, and with that, they have also increased their stake in the subsidiary, which is JEM, that's Jupiter Electrical Mobility, from 60% to 75%. The company is to set up a plant to manufacture close to about 10,000 vehicles annually. But what remains as a risk factor here is the competitive intensity. While the company has stated that currently there's one player in this field, how would the margins be impacted with the kind of addition that these kind of order inflows bring to the business is something that has yet to be seen. Coming to the second point on the bull bear case scenario, it's the non-wagon revenue, which is expected to contribute to about 50% of the revenue in the next 4 years that we are seeing. So what we are seeing that the wagon side of the business has remained until FY24. We have seen strong growth over here, but expectation is now for the non-wagon revenue to contribute significantly in the next 4 years. The company has also guided for a higher growth outlook coming from this segment, so that remains on a watch out for. However, there are a couple of risks of order delays that have been happening from Indian Railways. Even if you go to see and some of the conference calls of other railway companies also, they have noted that there has been a slowdown in terms of where the order offtake is for some of the companies, which have resulted in slower order inflows for the business, which can see an impact on the fourth quarter of this revenue. So that is something that should be on a watch out as well. Coming to the third point of the business is an interesting one, which is the wheel business, wherein they're targeting about a 600 crore of revenue, and this is from FY26 onwards. If you look at the current share, that's about 300 plus crore or something. So they're expecting this segment to pick up dramatically. We have seen that they are targeting for almost a 50% mix in the non-wagon side of the business. So more than 100% is the kind of jump that we are looking from the wheel business. However, again, order execution is something which is on a watch out for, considering the order inflows from the private sector has remained strong, but it's from the government side. If you look at the railway capex also, it had remained unchanged this year, and in the first 3 quarters that we had seen, overall railway ordering has been considerably muted. So that is something that has to be factored in as well. Which brings us to the final point, which is the expansion also the company is making in its Odisha to increase the capacity. To talk more about this, they're increasing the annual capacity from 20,000 forged wheels and axles to 1 lakh forged wheel sets per year. And this expansion is backed by a 2,500 crore of an investment that we are looking at. Commercial production is expected to start from December 26 onwards. So Odisha update is something which is going to add to the revenue contribution significantly. But this brings to the final point as to what we have seen for a couple of these railway counters is a steep correction. We have seen the stock going down about 36% in the last 6 month period itself. So valuations and execution are some of the concerns which remain on the railway side. Current, if you look at the trailing P, that stands in the range of 39 times, while that is the P has corrected. The concerns are now on the order inflows and the execution pickup for some of the railway names which are there. But Jupiter Wagons overall has a strong order book, and they're expecting higher orders from the EV side coming for the business. So this is a complete breakdown of Jupiter Wagons for you.
Well, thank you so much for that, Anushi. Stock on a tear, 11% higher in trade today. Let's quickly take a fundamental view first, and we have Neeraj Diwan joining, independent market expert, joining the conversation. Neeraj, Jupiter Wagons, one, with regard to its newest foray as well as overall how you view the business in particular, and even the broader landscape. If you can just quickly give us maybe a minute or two on what you and how you view the whole railway space and the capex now. What's the sense like at the current juncture?
Yeah, good afternoon. Yeah, actually, there was a lot of interest earlier in the railway stocks, and there's a lot of retail presence and institutional presence which had happened. And I think with this correction, you saw a good amount of, correction happening in most of these stocks. I think that the capex and the delay which was there from the railway side on some of the wagons orders and orders coming, that had really slowed down a lot. So that, according to my understanding, is picking up now because we're seeing some order flow coming back to these companies. So whether it's Jupiter Wagons or whether it's Texmaco Rail, and I feel that at these valuations again, it makes a sense for someone to invest for a little longer term. Even if you see last couple of quarters, I track Texmaco Rail more than Jubilant, so I can give you a better sense of that. So last couple of quarters results have also been very good. So even on fundamentally on pure valuation, it makes sense to invest at these levels. So I think in investing in 1.5, 2 years kind of perspective, it makes sense to invest in these kind of companies which are dependent mostly on our internal order flow, our economy, and our domestic government orders. So I think they will be better place to be in for the next 1.5 years.